President Trump's crypto working group just dropped a blueprint for US regulators designed to kick off what they're calling a, quote, golden age of crypto. Then, almost immediately, the Commodity Futures Trading Commission, or CFTC, hit the ground running with something called the crypto sprint, and it's moving at breakneck speed. That's why today we're diving deep into what this crypto sprint is all about. We'll examine how we got here, how it stacks up against the SEC's approach, and which corners of the crypto market stand to win big or lose out. My name is Guy, and you're watching the Coin Bureau. Okay, before we dive in, I need to make one thing crystal clear. Nothing in this video is financial advice. It's purely educational content designed to inform you about the evolving crypto regulatory landscape. If you need investment guidance, then please consult a qualified financial advisor. And with that said, if this breakdown sounds valuable to you, then smash that like button, hit subscribe, and ring that notification bell so you don't miss what comes next. Now, if you've been around crypto for a while, you've probably noticed that the industry tends to view the CFTC as the more crypto-friendly regulator compared to the SEC. But why is that? Well, it comes down to their mandates. While the SEC oversees securities markets, the CFTC handles US derivatives markets tied to commodities. Plus, it's got enforcement authority over fraud and manipulation in commodity spot markets. The CFTC already oversees the busy Bitcoin, Ethereum, Solana, and XRP derivative activity on federally supervised exchanges like the Chicago Mercantile Exchange, or CME. Even when a crypto doesn't have a listed futures product, the CFTC still has the authority to go after fraud and manipulation in spot markets. It's not a full regulator of spot trading, but it's got the tools, and it's historically earned a reputation for offering predictable, innovation-friendly oversight of crypto markets. What's particularly notable is that under CFTC rules, exchanges can list new contracts through a streamlined process called self-certification. As long as the product meets the requirements, it can go live quickly unless the CFTC intervenes. So, for crypto entities, being under CFTC oversight means simplicity, speed, and clarity. That's exactly why it's become the regulator most in the space would rather work with. In contrast, the SEC, especially during Gary Gensler's reign under the Biden administration, was widely seen as hostile to crypto industry growth. Even under the new SEC leadership, the same securities regulations fundamentally apply, creating constraints for the crypto industry. The industry's been vocal about this for years, and they've been putting their money where their mouth is. You can see this in their lobbying efforts. Earlier this year, Coinbase publicly pushed Congress to give the CFTC clear spot market authority for crypto. And whether you agree with Coinbase or not, that tells you exactly which regulator the major US platforms prefer dealing with. As it happens, the recent White House report essentially endorses that direction. It says the CFTC and SEC should use existing tools to, quote, enable the trading of digital assets at the federal level. But more importantly, the report endorses giving the CFTC clear authority over crypto commodity markets, that's non-security crypto assets. Well, the CFTC got the message loud and clear. On the 1st of August, CFTC Acting Chair Caroline Pham announced the agency's crypto sprint, launching an effort to implement the White House report's recommendations. Now, the first phase of this sprint is massive. The CFTC opened an initiative to enable spot crypto trading on CFTC-registered futures exchanges. These include the same federally supervised venues that currently list Bitcoin and Ethereum futures, like the CME we mentioned earlier. The agency kicked things off by inviting industry stakeholders to submit feedback and suggestions on listing spot crypto contracts on what's called a designated contract market, or DCM. Now, for context, a DCM is simply a registered futures exchange like the CME. And when we say spot, we're talking about trading the actual underlying assets, not futures contracts, on those same regulated rails. So, the CFTC is asking for real-world feedback on how to make that work using its existing regulatory toolkit. And that includes rules allowing exchanges to list new products through that fast-track self-certification process we discussed. The CFTC's announcement even flags some obvious edge cases, like what happens when a commodity token gets tangled up in an investment contract situation that falls under SEC oversight. In short, they want practical feedback before they lock anything down. And things are moving fast. Comments are due by the 18th of August. But why act now? Well, because the White House report basically handed regulatory agencies clear marching orders with executive backing. The report pushes both the CFTC and SEC to use their existing powers to enable complete federal crypto trading without waiting for Congress. The CFTC is literally just executing what it's been told to do. Now, there's something crucial to understand about this crypto sprint. It's not a one notice and done situation. The CFTC has positioned this as part of a broader program. They've already been removing outdated guidance, publishing fresh guidance, and taking public input on 24/7 trading and perpetual futures trading. Now, this spot initiative is simply the first and arguably the biggest official building block in this new regulatory framework. After all, it would bring day-to-day spot activity onto the same regulated US venues that already handle the overwhelming bulk of US crypto futures trading. For US traders and businesses that care about liquidity moving onshore, clearer custody solutions, and fewer surprise enforcement headlines, this is a critical part of the federal roadmap to monitor. The most important thing for you to monitor, though, is the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashback on deposits of up to 75% on crypto exchanges. These deals won't stick around forever, though, so grab them ASAP using the link below or scan the QR code on your screen. All right, now let's connect the dots between what the White House requested, what the CFTC is actually delivering, and where the SEC fits into this puzzle. The White House essentially told both the CFTC and SEC to use exemptions, guidance, and existing rulemaking powers to establish regulated rails for digital assets, and fast. The CFTC's crypto sprint is a direct response to that directive, getting the ball rolling on spot trading at the federal level. So, where's the SEC in all of this? Well, the White House wants the SEC to clear regulatory roadblocks so that securities rules don't accidentally block activity that could fall under CFTC oversight. That could mean things like allowing exemptions for innovation, updating outdated definitions, and adjusting rules to better handle tokenized assets. The SEC isn't sitting on the sidelines either. Under new chair Paul Atkins, the SEC launched Project Crypto on the 31st of July, a formal effort to modernize how it handles digital assets and realize Trump's vision for the US. And the SEC has already started showing its hand under this initiative. For example, a recent SEC staff statement outlined how certain liquid staking setups don't qualify as securities. That's a signal that the agency is beginning to define what's outside its jurisdiction, exactly as the White House requested. The White House report also tells regulators to allow bundle trading and custody where it's safe, and to coordinate on segregation standards. If the CFTC moves forward with spot listings while the SEC clears custody pathways for registered firms, crypto trading in the US faces fewer complications. It also means fewer US-based users seeing those annoying "sorry, US not supported" messages. However, some grey areas remain regarding SEC and CFTC jurisdiction. There's still the so-called morphing asset problem, tokens that may have launched as securities but now function more like non-securities. The White House report acknowledges this and urges the SEC to let those tokens trade on non-SEC platforms after their initial sale, provided proper safeguards are in place. If the SEC follows through, it would eliminate massive uncertainty for exchanges and traders. And it's worth noting that these issues are at the heart of the Clarity Act, a crypto market regulation bill currently being discussed in the Senate. However, it appears the White House report has already spurred regulators to move ahead and establish market clarity before any potential new laws. That's worth remembering. Whatever the CFTC and SEC decide about crypto regulation stands until Congress says otherwise. Another grey area, meanwhile, involves platforms wanting to list both securities and non-securities. The White House calls for a unified federal crypto trading framework allowing a single platform to offer a broad range of crypto and other regulated products, but the specifics are still being worked out. There'll be more edge cases as officials work through the practicalities. Some associated DeFi activity may brush up against SEC rules, and certain exchange features might resemble broker-dealers, which should technically fall under SEC oversight. Meanwhile, the CFTC must integrate listed spot trading into its existing rulebook without creating loopholes. But the overall strategy is clear. Use current powers, exemptions, and targeted guidance to navigate grey areas for the time being. The White House has set the direction. Now, the CFTC and SEC are clearing the path step by step, creating space for crypto to operate legally and efficiently at the federal level. So then, by now, you might be thinking, this all sounds pretty bullish for crypto, and you'd be absolutely right. But which segments of the crypto ecosystem stand to benefit most? Well, if the CFTC's first initiative focuses on listing spot contracts, the initial winners are the coins already getting the most attention on CFTC-regulated platforms, Bitcoin and Ethereum. They've already established themselves on CFTC-supervised futures rails with healthy trading volume, so adding spot contracts to those same venues creates a path with minimal friction. Then we've got leading altcoins like Solana and XRP, which also have regulated futures products already live. Sure, they haven't seen the same volume as crypto's flagship assets, but this arguably means CFTC-registered spot listings would have an even greater impact. If market sentiment turns increasingly bullish from current levels, traders may be tempted to venture further out along the risk curve. Smaller market cap assets come with lower liquidity, so even modest additional spot market buying could push prices substantially higher. While this could be bullish for coins like SOL and XRP as spot markets move onshore to the US, keep in mind there's more happening here than just price action and open interest. When spot and futures are listed on the same US venue, it opens the door for so-called basis trades. Now, this is a strategy where traders profit from the price difference between the spot price and futures contract price. Without getting too technical, a basis trade involves buying an asset like Bitcoin on the spot market while shorting its futures contract, aiming to capture the price differential between the two over time. That's especially attractive in crypto, where those price gaps can be significant, particularly with altcoins. The proposed CFTC framework would make it much easier for professional traders to execute these strategies efficiently, without worrying about crossing jurisdictions or platforms. The result could be deeper liquidity flowing to US venues, making US crypto markets more robust. But, perhaps most importantly for us, this specialized trading activity technically doesn't create any net demand for the underlying asset, so it's a net neutral outcome for this particular type of trade. Just something to keep in mind when you hear about record trading volume or open interest. It's probably related to basis trading. The CFTC is also exploring 24/7 trading and crypto perpetual futures on regulated exchanges. Now, while Coinbase brought perps to the US market just recently, a clear green light from the CFTC for such products across the board could trigger a significant market shift. Currently, perpetual futures on decentralized exchanges are generally off-limits to US customers. That's because the CFTC treats them as derivatives requiring trading on regulated venues. Most major DEXs offering perps, like for instance Hyperliquid, block US IP addresses to comply with these rules. That said though, it's widely assumed many US traders still access them through VPNs, effectively operating in a grey zone, or indeed an outright illegal one. If US operators, through the CFTC, create a fully legal and regulated framework for perps offering stronger security and guardrails, well, many of these leverage traders might be tempted to migrate from DEXs to SEXs. Now, when it comes to specific tokens, anything that still resembles a security or exists within an investment contract won't qualify for CFTC-listed spot trading. However, that's hardly catastrophic. It's just maintaining the status quo for now. Regarding SEC action, the Trump administration has clearly shifted the landscape. SEC Chair Paul Atkins has even stated publicly that most crypto assets aren't securities. Simultaneously, The Clarity Act, though not yet law, suggests tokens associated with projects making genuine progress towards decentralization shouldn't face punishment. So, while tokens tied to investment contracts still won't qualify for CFTC-listed spot trading, the message is crystal clear. If a token looks decentralized, it likely has room to operate legally in the US under CFTC oversight. More than that, though, regulators are actively working to facilitate this. And that reminds me, the White House is very explicit that fully backed stablecoins are on a separate track thanks to the Genius Act being signed into law. So, we don't need to worry about stablecoins getting caught up in any potential confusion. In summary then, the first beneficiaries of the CFTC's crypto sprint will likely be assets positioned for early spot listings on existing TradFi exchanges. That's Bitcoin, Ethereum, Solana, and XRP. Meanwhile, US venues able to list these under CFTC oversight stand to gain market share, while offshore platforms may lose ground as more trading shifts to regulated onshore infrastructure. And so, what's next? And when could all of this be implemented? Well, to recap, the CFTC is soliciting stakeholder feedback on how spot crypto trading could function on US futures exchanges, with comments due by the 18th of August. Once that comment window closes, CFTC staff will review everything. If the path looks clear, they can move forward using familiar tools at substantial speed. Simultaneously, the SEC will continue its work on Project Crypto. The Commission is expected to begin deploying its powers in the coming months, rolling out changes gradually over time. Here's the thing though, there isn't an exact date when everything will be complete. It'll be a gradual process consisting of multiple pro-crypto announcements. This means we need to monitor the early public comments rolling in for the CFTC's spot listing initiative. These comments will be posted publicly, and the early ones often hint at where things are headed. After the comment window closes, expect to see filings from exchanges as they begin certifying spot products under existing rules. Make no mistake, the momentum will then build as we get more updates on this regulatory transformation. We've got the roadmap, and the agencies are working at breakneck speed to deliver results. The CFTC has given us a deadline and process, and the SEC has essentially signaled that it's on board, or at least it won't obstruct progress. So, if both agencies stick to the plan, US crypto trading infrastructure could be facing a rapid upgrade that may well reshape the industry's future in the coming months, possibly even the coming weeks. Okay, if you found value in this deep dive, then make sure to hit subscribe and ring that notification bell so you don't miss updates on what US crypto regulators are doing next. And if you want a comprehensive breakdown of every crucial detail from the White House's crypto report, then you can check out our video on that right over here. Okay, that's all from me for today. Thank you for watching, and I'll see you in the next one. This is Guy, signing off.